In this video, we're going to look at Nexstar Media, which owns 197 television stations. And what I do in my videos is I run my discounted cash flow model to figure out the actual stock price for a company. And we also look at the financial ratios. Let's get started with the model. So this company has a market cap of $3.77 billion. That's the value of the company according to the stock market. And they're trading at $83.24. So if you wanted to buy one share, that would be the price. Now we need the free cash flows. And free cash flows are the cash that's remaining after a company pays its expenses. So you really need positive free cash flow because not only to grow the business, but also to provide your investors a dividend and a return. Next, we're going to pull the net income, and that's the profit and loss on the income statement. Next, we're going to pull the revenue, which are the sales on the income statement. And we put 4 years of each into the model, and you can see that net profit margins have been decreasing from 2017 to 2019. Net profit margins are net income over revenue. It's how efficient a company is at converting its revenue into profit. It's not a good sign a company is becoming less profitable, but we really need to look at the income statement to figure out what that is. But for the purposes of this video, we're just going to move forward. Let's get their capital structure. We need to know how much interest they pay on a debt. They pay $304 million. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liabilities. And current liabilities. So they have current debt of $109 million. That's debt due within 12 months. And then long-term debt of $8.4 billion. That's debt due after 12 months. They pay 3.6% interest on their debt. But interest payments are tax deductible. So let's get their effective tax rate. The income before tax is $373 million. And the income tax is $137 million. So their cost of debt is 2.27%. To get their cost of equity, we need the beta. The beta is how much the stock moves relative to the market. So a beta of 1 means the stock moves with the market. They have a beta closer to 2, so the stock moves twice as much as the market. If the market goes up, this stock goes up twice as much, and if it goes down, this stock goes down twice as much. The higher the beta, the more volatile and the more risky an investment is. Let's go back to the balance sheet because we need some more information for the ratios we're going to look at later. Let's get their current assets, which is on the balance sheet. That's $1.4 billion. And now let's get their current liabilities. Current liabilities are debts and payables which are due within 12 months, and that's $948 million. And let's get their equity. That's total assets minus total liabilities, and that's $2 billion. And we also need their EBIT, which is earnings before interest and taxes. On the income statement, that's called operating income, and that's $552 million. So that's how much money the company made in 2019 from its everyday business, but before it paid interest on its debt and taxes. So the cost of debt is 2.3%, and they have 81% debt in the capital structure. The cost of equity is 16.8%, and we used a capital asset pricing model to figure that out. And the weight of equity is 19%. So to get the weighted average cost of capital, it's a blend of the cost of debt and the cost of equity, and that comes out to 5.1%. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today, and then we get a value for the entire company of $6 billion. We divide that by 45 million shares, and we get an intrinsic stock price of $133. That's how much we calculate the stock is worth. Even though they're trading at $83, so they're trading at a 37% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. Their intrinsic stock price is $194, which is a lot higher than what I say is $133. So they're valuing the company even higher. But in both cases, we're saying the stock is a buy and it's undervalued. But you have to make that decision. What do you see the future of the company? Do you see it going up to over $100, or do you see it struggling? So let's look at the historical stock price. It looks like it was trading closer to my intrinsic value before coronavirus hit. Then it's come down a lot, and it's come up a little bit more, but it's still trading at a discount at $84. Stock price is based off of supply and demand of the market. The more people that want to buy a stock, the higher the price goes, and the more people that want to sell a stock, the lower the price goes. Let's look at the financial ratios. They have a PE ratio of 16, which is pretty good. That's price of stock over earnings per share. That's actually the median PE in the market. The average is 29. Value investors tend to look for 15 or below for the PE. They have a really good price of sales of 1.2. I usually like to see under 2.5. They have a good price to book ratio of 1.9. That's price of stock over book value per share. So investors are willing to pay $2 for $1 of book value. They have a good current ratio of 1.4, so they can cover their current liabilities. That's current assets over current liabilities. Their ROE is a little low at 11%. That's net income over equity. They can only cover their interest 1.8 times. And they have 81% debt, so they're a bit leveraged. They don't have that much more room to borrow. So let me know what you think in the video. Thanks for watching.